Shares of Disney are down 6.6% today after the company reported fiscal first quarter earnings. Now, the results were actually pretty good. There was growth in both the entertainment business and also in parks. Sports is maybe holding the company back a little bit, but we're very early on in the ESPN app launch. But I want to go through these results because I think long-term, this is exactly what you want to see from Disney. But short-term, obviously the market's not really happy with what they're seeing. And actually some disclosure changes were really interesting for the company following what Netflix did with disclosing a little bit less about how many subscribers there are on each one of their services. Now they're just reporting the big high-level numbers. So I want to show exactly what that looks like. My name is Travis William. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content. And thanks to this video sponsor, The Motley Fool. If you go to fool.com/ASYM, they'll give you their top 10 stocks to buy right now. So first of all, this is just a look at what the stock is doing early in trading, now down 6.7%. We're about midway through the trading day. And this is the company's quarterly results. Revenue overall up 5% for the quarter to $26 billion. Income before taxes, $3.7 billion, which was about the same as a year ago. And diluted earnings per share actually fell a little bit to $1.34 per share. But I want to go through each one of these segments here: entertainment, sports, and experiences. If you have watched this channel before, you know that experiences, this is really where the money is for Disney. But these other two segments are really important as kind of top of the funnel and long-term growth drivers. So let's start with the entertainment segment. Revenue was up 7% in the quarter, but operating income was down 35%. So why is that? Well, there was an increase in content costs from some of their newer movies, Zootopia 2, Avatar, Fire and Ash. These are going to be expenses that you're going to incur upfront. The payoff is going to be over the next few quarters. But if you take a step back, actually the results are looking like they're going to get better throughout the year. Segment operating income is expected to be comparable to a year ago in this current quarter that we're in right now. But video on demand, so their streaming business is expected to be much more profitable than it was a year ago. And if we go down here to full year fiscal 2026, remember, Disney's on a little bit of a weird quarter. The one that they just reported was first quarter fiscal 2026, but they expect to see double-digit segment operating income growth and an operating margin for that streaming business of about 10%. A couple of years ago, that was negative, well more than 10%. They were losing about $1 billion per quarter. Now they're looking to get that to be pretty profitable long-term. They want to get that operating income margin for streaming up over 20%. But the interesting thing in what they reported is what they didn't report. So when I first opened this up and I looked at the numbers, I always look for what are the subscriber trends for Disney Plus or for Hulu. They have taken all of that out. And the reason that they've taken that out is the same reason that Netflix did the exact same thing. They don't want investors like me, like you, worrying about, hey, here's what the subscriber numbers are doing. Here's what the pricing is doing. They want you to just look at the overall business. Now, I would love to have more disclosure, but that's their reason. And that's why companies are giving a little bit less information. So we'll see where this goes. I would love for them to break these things out more in the future, because ultimately the value comes from bundling Disney Plus with Hulu and ESPN. If we don't know if they're actually doing that successfully, I think it makes it a little bit more difficult to judge how they're doing with the business. What they do break out is the video on demand itself. So that's now $4.4 billion in revenue. You can see that's up 13% from a year ago. Revenue from advertising didn't grow quite as much, but overall 11% increase in revenue and a 72% increase in operating income. Okay, the sports segment, this is where things are a little bit more muddling. $4.9 billion in revenue, up 1%, so barely moved in the quarter, and operating income was down 23%, so $191 million. Now, like I said, they did launch their ESPN streaming app, starting to bundle that with Disney Plus and Hulu, but that is something that they're not pushing quite as much as we saw with something like the launch of Disney Plus. They're including it with a lot of subscriptions with cable, so people who have a lot of their cable subscriptions can get access to ESPN Unlimited, but they're not going all in. They're not burning the boats of cable. Still have ESPN there. That's still going to be a vast majority of the users, but the subscriber numbers are declining for ESPN, even though the price per subscriber, the fees that they get, those continue to go up over time. If we go up to their guidance, this current quarter, they're expecting revenue to be about flat from a year ago, but operating income to be down about $100 million. And for the full fiscal year, a low single-digit segment operating income compared to fiscal 2025. But if you're a Disney investor, what you really want to be focused on right now is what's going on with experiences. Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now. This is the parks. This is the cruise lines. This is all of the interactive experiences they have. This is what really differentiates Disney's business overall. You can see that revenue for experiences was up 6%. 7% in both domestic and international, and then kind of flat for consumer products. But operating income was up 6%, now $3.3 billion for the past 3 months. They are now well over $10 billion in operating income over the past 12 months. The great thing here is this comes before the huge impact that we're going to see from spending about $60 billion over a 10-year span to increase the number of attractions, to increase hotels. They have expansions at every single one of their parks around the world, and they're launching more cruise lines. I think there's 5 or 6 coming in the next 4 or 5 years. So that's going to increase their potential for revenue growth and operating income in this experiences business. If you own shares of Disney, this is what you want to see consistently growing. Some of those other things, the movies in entertainment, those are going to be a little bit volatile. Sports maybe isn't going to be super profitable until they're able to aggregate that demand for sports and actually buy more sports rights. But the consistent thing over the next 10, 20, 30 years is going to be experiences. From a guidance perspective, expecting modest operating income growth for this current quarter, and then for fiscal 2026, single digit operating income growth compared to fiscal 2025, weighted to the second half of the year. And this is as some of their expansions, like they talked about right up here, the launch of the Disney Adventure, the new Frozen World in Disneyland Paris, those aren't going to be really contributing to the business until the second half of the year. So here you can see some of their operating income trends, and you can see maybe why investors are a little bit disappointed. Some of these operating income numbers coming down. It's not coming from the parks business, and actually ESPN's holding up pretty well. What you're seeing is a little bit of weakness in the entertainment business. And again, that entertainment business is going to be volatile quarter to quarter because they don't necessarily know how each one of these movies is going to perform. If you have a huge year at the box office, that's going to help the operating profit. If you have a bad year, it's going to hurt the operating profit. You also don't have the streaming business quite hitting scale yet. So there is an offset to the losses at cable. That's the business that's in decline. That's going to show up in in the entertainment segment. From a revenue perspective, the streaming business is more than offsetting the losses from cable, but from an operating income perspective, that's not quite the case yet. So that's why you see this decline. But long term, I think you are going to see this move positive, and we are going to see probably a pretty good year in the second half of 2026. Part of the reason for that is they have a huge slate of movies coming out. They have Toy Story 5. There's a Mandalorian movie. There's also an Avengers movie coming later in this year. That's going to be in fiscal 2027. But the entertainment business looks to be doing much better than it was a few years ago. You can see that with Disney just dominating the global box office over the past few years. I think that looks like it's probably going to continue in 2026. So why do I think Disney is being overlooked? I think the valuation for Disney is just too good to ignore right now. You can see that the entire enterprise value is only about $250 billion right now. But the price to earnings multiple on a trailing basis, 16.5, forward basis, 15.5. If we do start to see some operating leverage, especially in that entertainment business over the next couple of years, as the streaming business grows, as we see more competitors fall by the wayside, I think Disney's actually really well positioned. The foundation for the business is experiences. I think both entertainment and sports are going to be a much better financial position in 5 years or so than they are today. We're still seeing those declines from cable. We're not quite seeing streaming pick up the slack quite yet, but that's what's coming, and we know it's coming from Disney. So buying shares at a mid-teens multiple for a company that I think we probably know is going to be around 30, 40, 50 years from now, I think that's a great value for long-term investors. But let me know what you think in the comments section below. Don't forget to subscribe to Asymmetric Investing. Thanks for watching, everybody. See you here next time.